What a day, man. That was just insane going from being so back after the nvidia earnings to being so over all in one session. It's pretty crazy. I don't think I've seen that before.
Yeah, I mean, like, let's just take a look here. Oops, all right. All right. Um, I mean, what a gap and crap on Nvidia, man. Just
Yeah.
actually like it's one of those things where within 24 hours you invalidated both sides. You know,
Yeah.
the Bears right after earnings, and then the Bulls in the following session. And I think it's like one of these things that a lot of people don't see, can't foresee coming, obviously. But it's one of these things that we have to expect and risk off. Like things like this just tend to happen, you know?
It's kind of been a trend with all the other earnings as well. Like it's gotten to the point where like even good news is bad news. Like it just can't meet the expectations of the market.
No, I mean, I think what's going on here is like you're in this situation where the market is not pricing in a recession. So if you look at the stock market and you're wondering what's going on, like equities are selling, like the the broad-based indices are not pricing in a recession. The bond market not pricing in a recession. To be honest with you, Bitcoin not pricing in a recession,
I mean,
even though
even
it's
even
yeah.
inflation swaps, like inflation swaps would be below 2% if they were pricing in a recession.
Yeah, especially one that's not stagflationary in nature, and I just don't. I honestly don't know if we like. I think the Fed's in a position right at the moment where they have some offset on stagflationary pressures to the point where like we'd rather see deflationary pressures, or we would end up seeing deflationary pressures instead of stagflationary pressures in a true like real slowdown, I'd imagine at this point.
Yeah, but we really need to see commodities breaking down. I think that's really the last leg that's holding everything up. I think what we're seeing now is the hot air coming out of the elevated expectations, especially around these AI names, which have just been leading the market higher. Now that is all coming out, but it's not really like a growth shock. It's just okay. These expectations are stretched. They're getting revised now, and
Yeah, don't get
it's
me wrong though. The growth index, our growth index is in the toilet. Things
oh
cooked,
yeah,
right?
that thing's
Growth
cooked.
expectations are cooked. But what you're really emphasizing here, and I want to add to it, is like we're not at the point where GDP where the market's expecting like significant decline to GDP or a significant stall out of GDP. This is more of just like expectations in in market leading sectors were very, very hot, and even if they cool down quite a bit, that's not necessarily recessionary, but it does take a lot of it just reduces the multiples on some of these bigger names that have been leading the market, therefore bringing prices down a bit, right? And we've been seeing. And your point with commodities, right? Like in a true growth shock, a true outright growth shock, which it almost looks like there was some of that action today in commodities traded more risk off today than any other day in the last couple of weeks, to be honest.
Yeah,
And
but relatively not that great. Like GSG is not even down as much as the SPY.
no, right, but I'm not sure if we should be looking for points there. But ultimately, like GSG's held up a lot better since the risk off pivot than equities, and I think that this is just like the market's uncertainty to write off inflation. And it's one of these things that like there is our inflation index was showing some real signs of resilience the last couple of weeks. And we mentioned this last week. I think we mentioned this in the ledger post. Did we write about this inflation swaps in the ledger post?
Yeah,
Yeah, that ultimately like there is going to be some weakness in our inflation index. We think we don't react until the models react, but we think that inflation impulse has probably peaked, and we put that article out last week. And I think that ultimately what needs to happen here for the next saga of material decline in risk assets is that actual segue from expectations are too hot to okay, we might have a growth problem. And I don't think we're at the we might have a growth problem yet. And some people will take that as, oh, bullish. That means buying everything. It's all good and dandy. But like the reason why we have our regime system set up the way it is because figuring out the pivot point to where expectations are too frothy and they're recalibrating versus like they end up going completely off a cliff and you end up going into a growth shock. It's a very blurry line. And you can timing that line is something, or timing that pivot is something that you can't, no model is really going to do for you. You have to just really just use your gut. And we don't make decisions with our gut at Market Radar. We're very systematic. So therefore, our models are designed to really shift around the risk buckets, right? Risk off, risk on, and slow down. And as long as we're on risk off, the risk is there for a pivot out of those deflating expectations to outright growth shock. And as long as that pivot's on the table, we have to be cautious. And we said this, it's funny enough, like everyone's talking about AI this week, but like last week, we were actually talking about this on the podcast where we're in a risk off regime. So essentially what that means is if we take a look here, we've been in a risk off regime for over a month now. And typically the market does see decent declines in risk off and conditions do go to crap in risk off. Risk conditions, go risk off and risk off. That's what tends to happen over the long term. And just from a fundamental approach, if we're in a risk off regime and the odds that the market falls rise, well, then systemic issues that come along with those market declines also rise. Meaning like if there was going to be an issue in a theme, in a sector, whatever it may be, it's going to happen in a risk-off regime. In a risk-on regime, the market's going to just continue to go up. So there's no real detrimental shock. Like, for example, what we're seeing now, this AI expectation, the deflation of AI expectations, right? Like this would be, if this were to pop, if the AI bubble were to pop, it would happen in a risk-off regime. It wouldn't happen in a risk-on regime. So our fundamental approach is, since we're in risk off, do we think the AI bubble is completely over? Do we think nvidia is going to fall 50%, 30, 40%, complete fallout in demand? That's never our base case. But what I will tell you is if it were to happen, it would happen in risk off. So given we're in risk off, we just have to take the approach that like, look, expectations are quite high. They could be reset and maybe there's a growth shock on the horizon. Now, what I think we'd have to pay attention to, the two main things is, number one, obviously the market, right? Everyone's getting all spooked here. We're obviously sidelined risk assets for over a month now, but even after today's abysmal earnings gap up and fade due to the nvidia pump last night, the NASDAQ is not bearish trend yet. And ideally, I actually don't want to see the market go bearish trend. I'm sure that's the same for you.
Well, yeah, I mean, it's the issue with going bearish trend is like it's going to be a lot harder to get out of that and get a good entry on the way out.
Yeah, not only that, it also may mean that equities become uninvestable for a lot longer, right? Like we see more prolonged shocks and negative effects in the market in terms of declining asset prices, and ultimately we want to be long risk assets. That's where we want to be. And I think that there's a juncture here that we have to observe, right? So we are currently at a point where equities have been selling off for the better part of all of November at this point. And we are not below Momo yet. The trend is still bullish. So I think the first point that is going to come is going to be, if we test Momo, do we hold? And I think holding Momo on the test for a bounce is probably something that at this point seems like it could happen, right? Like it's very possible we get to Momo, we consolidate, we put in a bounce, and then after that we figure out where markets are going to go from there. And I think like if that would be ideal if that's the entirety of the growth scare, in my opinion. That would be ideal, and we can shift back to risk on, and we can go on our way up to new all-time highs over the next couple months. But on the other hand, we have to observe here that if Momo does not hold, the odds of conditions worsening continue to rise exponentially. So I think that's where we are right now in terms of equities. Now, something to look at besides just the NASDAQ, again, is commodities. We were speaking about this. Like weakness in commodities, I think, would be a signal of amplified risks in the economy in terms of growth shocks, et cetera, right? And commodities they're weekday today, but they're still above Momo. So again, going to be hard, I think, to take this market down to the gutter without breaking commodities down. So today was the start of a crackdown, but I mean, we're still above Momo. And finally, the commodity that I am watching the most and I'm most attentive to is copper. And copper
Can
is a
you
construction
explain?
metal.
Yeah, can you just
Yeah.
explain like why you're looking at copper the most?
Yeah. So copper is a construction metal, right? So it goes from everything from housing to um, commercial projects, right? And on top of that, obviously data centers. So it's a construction metal, and it obviously has a lot of use cases in the construction realm, from electricity um, to well, cables, right? And computer components. So I believe that if copper shows signs of resiliency, like in terms of not being able to break down, it's just like an underlying signal of continuous demand. Like there's demand, right? There's some sort of pulse in demand. Now, if copper starts cracking, like I drew this line here, it's just my, we don't really follow trend lines. We follow our DDAT script, but these are just things that I draw, just visually put it together. And copper's been on this steady uptrend ever since the collapse over the summer when Trump printed some tariff exclusions for copper, and copper dipped, and it was able to rebound quite steadily. And I think that if we start rolling back over again, that's going to be problematic. And specifically in terms of like, remember, this is also tied to the data center build out. Like the idea that like we're building massive data centers, so copper is going to have a perpetual bid. You could kind of make the same argument with uranium, right? Like uranium is on the way down as well. This is a bit more specific towards data centers, right? And not so much like copper encompasses many more sectors like again, general housing construction, commercial buildings, like other things beyond data centers, where uranium is more just power, right? That scope. So it's a bit more isolated. I think the failure of copper at this point to truly break down and accelerate lower, like print 4.75, maybe 4.5 down this way, is kind of what's holding up the idea that like this we're having this steady inflationary impulse. And I mean, you take a look at our inflation index, right? And it's slowly rolling over, but it's not really at Momo yet. Nothing like growth. So I think like copper is giving us just a signal here that as long as it's pushing and pulling above and below Momo, it's kind of telling you like the growth scare isn't really there yet. And in terms of like, well, let me put it this way: the the true growth scare isn't really there. Where like you can have this growth scare that we're seeing right now, where just expectations reset, but like a real hard growth scare just isn't there yet. And I think that's what copper's telling us at the
Yeah,
moment.
I
So
think the market cares a lot about copper because it is very um it it matters a lot for the AI space and kind of understanding how this AI space is growing, if it's still growing at the pace that the market has been expecting it to grow at. And we've got AI being such a large part of driving growth lately, like productivity due to AI. Obviously, that's a theory. You can't say for sure that the productivity gains that we've been seeing this year are 100% due to AI, but I think that's really what the market cares about is okay, if this AI bubble is bursting, and copper's an indication of that since it's very isolated towards AI, now you have a very close correlation to productivity growth, which has been boosting GDP. So all of a sudden now, okay, copper's rolling over. That means AI is rolling over. That means this productivity boost is rolling over, which directly affects GDP. So I think
right, and I
that's
think
why the
yeah,
market cares a
that's a good
lot about
summary.
copper right now. And you can
I
really
think
see
so.
that. You can see whenever copper is selling off hard, it turns into a risk off day.
Yeah, and like bonds have been stuck in the mud lately, and they kind of seem to really only be moving around or having some excitement when copper is moving, and copper hasn't gone anywhere, and neither have bonds. So I think the market is just I think there like when you look at just GSG as a whole, right? Commodities haven't gone anywhere. People will look at crude, and crude I think is one of these things where the supply due to OPEC shifts have opened up this illusion where like you have greater supply coming onto the market, which is putting downward pressure on price, which isn't necessarily a signal of weaker demand, right? And this is not the same for every commodity. So I think like the reason you're seeing crude just really weaker than a lot of other commodities is it just has a different supply dynamic. And ultimately, the basket as a whole, GSG, is showing us that look, like commodities are not really weak yet. And I think they may get weaker. And I think with that being said, obviously we need commodities to go bearish trend, but they're getting to the moment where they're not bearish trend yet. And all in all, what this is telling us simply is look, like the growth shock, the true growth scare isn't here yet. And you can watch this, maybe if you're still long equities or you're trying to, get get precise here with trying to buy a dip. I would say like equities are going to have a hard time, especially the non-AI related names. I should say the indices, right? The indices are going to have a hard time materially imploding without commodities, I think, legging lower.
Yeah. And I think like anyone that's looking just to day trade and buy the dip, Momo is probably the best spot where we're going to see some resistance.
Yeah. Now, granted, we are in risk off, so I don't want to hear some, the trolls on X go like, if we clip Momo here and we just start dumping, like, yeah, look, the risks are in equities as we've been saying for a month and almost a half now, is to the downside. The risk to equities is lower, but equities do not have a bearish trend at the moment, which means they have this push and pull relationship going on right now, which you can obviously see. Like we're drifting up and drifting down. We're not really going anywhere. We're not much lower than the 10-10 lows, but we also didn't go that much high. I mean, we went up and we came back down. Things haven't really shifted that much since 10-10. And I think that's just, look, risk off is here and we have to respect it. And those that are trying to fade a dip, this is not a regular risk on dip. Like if this was risk on, our attitude would be completely different right now. We'd be saying like, this is the best buy opportunity ever. Now, if you're trying to day trade or swing trade, like Momo bounces are good like trigger points, but we obviously don't do that. But we've seen it happen time and time again where there is some sort of bounce. And ideally Momo does hold for the sake of the bulls and the sake of just the market overall, because bear markets in equities, Bitcoin's already cooked, but like a bear market in equities is not fun, and they can last quite a while, and they can really destroy sentiment along the way, and that's the last thing we want. Like at the end of the day, yeah, we're bearish on Bitcoin, neutral on stocks. We've been sidelined risk assets for a while. It feels good, being out of a lot of this volatility. But at the end of the day, we want to be long a bull market in stocks again. Like that's what we're hoping for.
Yeah.
And right now it doesn't look like that's coming around the corner in terms of, I mean, again, just like you look at growth is cooked. For now, maybe it bounces.
A question that we get asked often is like, how long is this risk off going to last? When is this going to be over? When are we back to clear skies? And the answer to that is there's really no way to know. There's absolutely no way to know. And you pretty much just have to ride the waves. That's what we do. It's risk off until it's not. That's pretty much how we play it. Like, I don't know how bad this is going to get. It might not be bad at all. Maybe the market's just going to go through a little bit of a choppy period and then we head higher from there. But as of now, it's risk off. We stay risk off.
I think that's a good point, because we actually do get that question a lot. And to put it simply, like what I can tell you just from an observation, anyone can make these observations if they have access to our tools on our website. This is not like some internal take or anything. For us to go long equities, there's a 2-filter process, right? A double condition. We need to have equities in a bullish trend, which they currently are, and we need to be in a risk-on regime, which means growth needs to be bullish. Growth is currently very much in the gutter. So the odds of us buying stock in the next week is pretty much 0% at this point. Unless growth miraculously goes above, miraculously goes vertical and just gigasends. The odds of us buying stock is just low to impossible at this point, at where we are today. Now, maybe in the next week, things change progressively, right? But like the way we operate is we don't, it's not a coin flip every day. There's some general direction the system is giving us. And I think that like a lot of people don't get that aspect where like in reality, the odds of something significant happening in RQF over the next week is low to none. Basically just, a holding pattern at the moment. And equities do need to hold Momo. And I think like what you saw today was in some weird ways kind of lethal for expectations, because the longer this goes on, the more questioning goes into expectations, and it's more of like a cyclical, it's a flywheel, right? The more people become concerned about the ability for these AI companies to scale the way that they're proposing they will, the more risk gets taken off the curve, and it's kind of, again, a flywheel where it continues until either sentiment immediately shifts. Like, for example, NVIDIA earnings, in a risk-on environment, NVIDIA earnings would have been that sentiment shift. We tweeted that the odds of NVIDIA saving the market are low. And the reason for that is we're in risk off. There have been dips in the past year where NVIDIA has contributed to a recovery in risk assets, which is why everyone was looking for NVIDIA to save the market, because that's what has happened. And that was happening in our risk on regime. But we're not in a risk on regime, which is why fading things like this become more and more obvious. And I think like as the patterns become more and more obvious, that sentiment starts shifting more aggressively. So ideally, equities kind of put in some sort of bottoming here around, QQQ at 577, 578 is like somewhat of a bottom. That would be the goal, consolidation, and just a reset and chill out of growth expectations, bringing impulses higher. But I don't think that's going to happen. It doesn't seem like it at the moment.
Yeah, no, definitely not. It almost seems like it wasn't even that panicky today. It was very structured selling today.
Yeah, I mean, if you look at the Nasdaq, yeah, it wasn't crazy. I mean, we slowed down around yesterday's low, but it wasn't too bad. I think what was worse was just the sentiment shift in 24 hours, right? From everyone being so back last night to just being so cooked by the close. Now, I mean, at the end of the day, like Bitcoin, I gotta say, like at some point here, what's gonna happen? People are gonna just bug out on the timeline when this does. I think at some point this is gonna bounce. If anything, it's kind of feeling like that. There's gonna be some sort of bounce here at some point. If the bounce doesn't start, maybe the bounce is starting now here around 86, 87, but there's going to be there's going to be a counter trend bounce, right? And as long as Bitcoin stays below, at this point, 97K, roughly there, this is going to be entirely just a bull trap. It'll just be a bull trap. Obviously, you guys know, for us to see significant change in Bitcoin, we have to go bullish trend. But I will say this, if Bitcoin can reclaim mid-vamp, there's some hope of higher prices and consolidation. But once we lost mid-vamp early in November, late October, it's been down only. And this is like the typical signs of a bear market. Now, could we put in a bounce here and change that? It's possible, but we've been sidelined since 116K, and we're just going to wait for our system our models to give us the update, because we're going to go in with 2 times leverage when we buy. And we don't really care about buying at 87K, 110K, 105K. It's irrelevant to me. What I'm trying to do is I'm trying to isolate the next bull trend, the next upward steady price rise in Bitcoin and crypto, and just leverage it and ride the wave. I'd rather be long that than to be long this disaster with 2 times leverage. We're talking, 50% drawdowns here at this point.
Yeah, and I I don't see that happening anytime soon, to be honest. Like with even just how far Momo is right now, like we really need to see Momo come down quite a bit, or price needs to go up. But like, what is going to drive Bitcoin higher? What is the bull case? I don't even know what the bull case is anymore. There is none.
Yeah, I mean, the only bull case I could think of is us pivoting back to a risk on regime. That would probably be it. But like I just said less than 5 minutes ago, 10 minutes ago, the odds of that happening at the moment are slim to none. So for Bitcoin's in no man's land. We're obviously not long. We're certainly not short, and we certainly are not thinking about shorting down here. So if there's anyone with that bright idea, that just log off. Like
Yeah,
don't do
this is
that
really
now.
the regime of touching grass.
Yeah, dude, like you really want to be in a position where the next period of steady rising price action in Bitcoin, or call it the next period of stable prices in Bitcoin, we're obviously going to be long that with leverage. And that is a very simple process. Like you don't want to touch Bitcoin when it's moving like this because it's a headache. Like I'd rather be long Bitcoin where I buy it. Like from I think we bought May 5th, right? That was when we went long. So Bitcoin was long May 5th and it was a sellout here. Steady rise, no some declines, but nothing crazy, right? You can buy and touch grass and come back when the signal arises. When you're in this chop here, like no one can tell you what's going to happen, but I can tell you what's possible. Bitcoin can go from 87 to 97 and back to 87 in a week, and you're just sitting there round tripping everything. So for us, it's irrelevant. Now, what I will say is this is probably one of the worst looking risk assets out there, right? Like I'm sure Artie, you can confirm this.
I
Like
think
out of all the
Ethereum looks
things,
worse
even
actually.
oh no, we're not gonna tread deeper into crypto. I'm gonna stay at the top level. Like for example, the only thing that probably looks worse than this is CoreWeave. I'd have to say, like this thing looks cooked. But I mean, Bitcoin is up there. I mean, Bitcoin is probably the worst like large cap or mega cap asset that looks like crap. Now, I think that's probably some sort of signal that you shouldn't ignore when Bitcoin starts trading like this. Something's cooked. Is it the jobs report? I know that's another thing, right? We got this jobs release this morning, um, going back to September data, which should have came out in October, but the shutdown and whatnot. And the unemployment rate slightly ticked up, but we had saw a big jump in job creation, which may get revised lower. All in all, what I think that is showing you is absolutely nothing. Like the market didn't sell off on the jobs print. Bitcoin is not down because of the September jobs print. Like the entire print is too old for it to make a difference, right? Like you're looking at data that is 3 months, 2 to 3 months old at best, right? And you have no real time. The only thing that you can have for real time impulse at this point is now we got jobless claims back online in the ADP weekly report. And we look at the ADP pulse. We put up a post about that on X. There was this decline of job creation into basically job losses into the end of October and slight rebound throughout the end of the month. But I think the market's at a point where these frothy expectations for AI are going to be tested. I mean, like you could, like I said, look at CoreWeave, look at these AI names. It's not, and I think we're in a unique situation right now because like, just put Home Depot in, right? There's no AI in Home Depot. Look at this, right? Look at Home Depot. Like what happened? What happened to Home Depot? Why is this company down like this? Earnings cooked, stocks even lower, right? There's no AI here. So like a lot of people are just looking at it like, oh, it's AI, but in reality, it goes a little bit further than AI. And I think that this is where like the confusion's happening because what we were speaking about earlier, and this is the blurred line at the beginning of the podcast that I was talking about, like if it was just an AI pullback, Home Depot wouldn't look like this.
Yeah, I mean,
Home
like
Depot's at Liberation Day lows.
look at everything else too, like other sectors, like the financials, industrials, consumer staples. Like they've none of those ran up with the Nasdaq.
Yeah, so you obviously have this dispersion going on. Obviously, AI concentration, and like, don't get me wrong. I think the AI wave there is some merit there. That's what's crazy. This is one of those confusing bubbles where like these companies can earn money and they can have real innovative tech, and like you can't just be a perma bear and say it's a scam. Michael Burry says it's a Ponzi. It's all going to zero. Just you need to chill. You need to really chill because there is some use case for AI. And I think like we actually saw that. I would argue that in 2022 we would have had a recession shortly after, if ChatGPT didn't hit the market and accelerate massive spend in AI, massive AI capex wave. And the reason why, like, so if you look at the market and you look at what happened when ChatGPT came out, which is roughly like right around 2022, right? So it's like right around here. What happens when the market declines is you have this wealth effect multiplier, right? Where like people lose assets when in market declines. Obviously, like the market values of their assets go down. Understandable. But what ends up happening too is expectations get created too, where people aren't willing to make investments. People aren't willing to do certain things. People aren't willing to spend money the same way. They'll think like, why would I invest in a startup if the S&P is down 30%? Is this startup going to even make it? I mean, this was the year where remember FTX, right? FTX got zero pretty much in receivership. So everyone's wondering like, oh, is this going, is this a good time to make moves? And obviously there's opportunity at many points in the risk cycle, and in bear markets, some of the best, but generally it's harder to raise, right? Money if you're a company. And I think what AI did was it accelerated a capex wave that would have not come to fruition, meaning the data center build outs, the surge in, like, for example, like the secondary effects like Caterpillar, right? Like look at Caterpillar, like since 2023, just things up 100%. Like these secondary effects would have not happened. And I think ultimately, like AI has shown some use case. So you can't write the whole thing off as fugazi. Like there's reality there. And I think as long as that's present, you can't just say like the whole bubble is going to go to zero. What I think you have to say is, have too many players entered the space that don't deserve their multiples. Like, does Palantir deserve its multiple, or could that multiple be cut in half, and is it still a good company? That's, I think, where like the game is being played at the moment. And does that continue? We'll see. But in terms of like rates, like even if we just take a look at the 30-year, like as bad as the market's been, there's no recession. This is like you're in the 5.1 to 4.5 30-year corridor. Like there's no recession here. Anytime there's any real stress, you're gonna, like in the last couple of years, you obviously the last summer labor scare was where Sam Roll triggered. You saw the 30-year trade to 4. Liberation Day going into it, you saw the 30-year trade below 4.5. I think as long as you're not below 4.5, what it's telling you is, number one, the recession risks the market's not pricing in recession, and term premium is still elevated. And there's this just uncertainty around inflation, future inflation. So as long as that's the case, I don't think you're going to get a real recessionary shock in the market. So for us to see that shift goes back to one simple thing. In our book at this moment, our viewpoint is commodities. If commodities break lower and start shitting the bed, to say, then that's going to be a problematic sign, and we're not really seeing that at the moment.
Do you want to wrap it up there?
Yeah. So thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com. We're going to be continuing the discussion in Discord with our Q&A.